Welcome back, friends. In the previous video, we had discussed about the meaning of operating cycle, and this video shall be focused on how do we calculate operating cycle and what are the key disadvantages of operating cycle. Why I say that operating cycle is not so much trustworthy for making lending decision. Okay. So this is the simplest of formula that we had discussed in the previous video. I don't follow any academic formula. In academics, you will find some other elements as well. While in practical, when you do practical work in banking sector for making lending decision, I'm not talking about any financing decision. When you work in a corporate and do a financing profile, CFO profile, there you will do more of academic calculation of operating cycle. But when you work in a banking sector, you do funding to MSMEs and various other clients, and then you do not go in that much of depth for calculation. You stick to simplicity. So this is the simplest of the thing that we do in banking for calculation of operating cycle. We pick up stock holding days, we add up debtor collection period, that is our gross operating cycle. Then we deduct the creditor repayment period, it is our net operating cycle, which we call actual operating cycle. Okay. So these 3 points we will discuss in this video: stock days, debtor days, and creditor days. So let us begin. So these are the two financial statements, a one income statement and then balance sheet. Income statement is also called profit and loss account. Profit and loss account and income statement gives us the expenses and revenue detail for a timeline, for a period. Okay. So balance sheet gives us position of liabilities and assets on a particular date. It does not reflect the position of previous days. Okay. But the income statement and profit and loss statement represent the picture on total basis. Suppose if I have prepared the income statement from 1st April 2022 to 31st March 2023, then the transaction reflecting in of expenses and revenue represents the total of transactions that have been done during this period from 1st April 2022 to 31st March 2023. While in balance sheet, if I have prepared the balance sheet as on 31st March 2022 and I have the figures of debtor, stock and creditors there, then the position, it tells me the position on 31st March 2022. It will not tell me what was the balance of debtors on 30th March, on 29th March and any other previous day. It will only tell me the position of 31st March only, while income statement gives me the result of whole timeline for which it is prepared. Okay, so this is the key difference that you need to understand here in full. Okay, so this is our example, a simplest of example I have taken. There is a sale of $100, closing stock of $25, opening stock of $30, purchases of $60, direct expenses of $20. Then we have our gross profit of $15 here. Then these are other expenses and net profit. In our example, we are not concerned with these for now. So we are concerned only till this part, only till gross margin part. So in operating cycle, we are discussing stock, debtors and creditors. So all the three items are found in the balance sheet. Debtors and stocks are assets of the company, so these are found on the asset side, while creditors are liability, so this is found on liability side. So what is debtor? What is debtor actually? Debtor is nothing but receivable pending from sales. Pending from sales. If I have sold good worth rupees $10 and the debtors are rupees $2, that it means that out of these $10 I have not received $2 as of yet. So these $2 represent the receivables from sales, pending receivables from sales. This is our sales. This is our sales, or we can also say it, this is the total receivables of the business. This is the total receivable of the business. Similarly, for creditors represent the pending payable amount and purchases represent the total payable amount of the business. So out of the total receivable of the business, this much receivables are pending to be received. So therefore, the debtors are always linked with sales because debtors are always generated from the sales itself. Similarly, the creditors are always linked with purchases. since the creditors are part of purchases itself. But the stock is linked with cost of goods sold. Stock is linked with cost of goods sold. If you are in foreign country, then you have heard of IFRS. In India, Ind AS, which is International Accounting Standards. International Accounting Standards. These accounting standards tell us that the stock should be valued. Should be valued. How do we calculate the value of stock? These accounting standards tell us the stock should be valued at cost or market price, whichever is less. I am not talking about the replacement cost here. Stock or market cost or market price, whichever is less, shall be the value of stock. So in practical cases, no businessman will tell you the market price of the stock. Okay, even if the market price of the stock have declined below its cost, the no businessman will tell you this. Okay, so this is always technically, although it is incorrect, technically in books of account, this is always valued at cost. So what is cost? Cost is cost of goods sold. Cost is cost of goods sold. If I go in even more in depth, the stock is divided into three parts: raw material, work in progress, and finished. If you go to your academics, then you will find that the raw material is always linked with the raw material purchases. It is generated out of purchases. Work in progress is linked with cost of production. That is raw material consumed plus manufacturing expenses. Finished goods is linked with cost of goods sold. Finished goods are linked with cost of goods sold. This is the accurate way to do it, which we do in our academics. But we are doing banking here. We are not doing any academics. We want to get a bird eye view of the client financial and client's business. We don't want to go in such depth that we make a whole thing cumbersome to understand for us. Okay, so we want to get just a bird eye view. So we pick up the best possible thing that we have, cost of goods sold, which is easiest and simplest to pick up and understand. Okay, so whole stock we do calculation based on cost of goods sold only. So how do we calculate cost of goods sold? Cost of goods sold is simply sales minus gross profit. In our case, $100 sale is there, minus gross profit of $15 is there. So $85 is the cost of goods sold in our example. Okay, so stocks are always linked with cost of goods sold. So this is because of accounting standards that we follow. It is logically correct as well, but I am not discussing any accounting here with you. I'm discussing banking with you more. So I am not getting into why we pick up cost of goods sold here. I am not talking about this. So let us calculate our debtor days. So what are debtor days? I have already told you that the sales are total receivable of the business. Debtors are pending receivables from the sales. So what are debtor days? What are debtor days? If debtors are pending receivables, then what represent debtor days? It represent the how many days are these receivables are pending for. Okay, how much time it takes to collect payment from the customer. It is the simplest way to say about this, simplest way to define it. Debtor days are always also called debtor collection period, debtor holding period. It has different names. We will simply call it debtor days in our example. Simplest way to define it, how much time it takes to collect the payment from the customers. So in our example, if the sales, by sales I mean total receivables, if the total receivables are of $100, then how many days it took to generate these $100? How many days? For which the period, how many days represent the period for which income statement or profit and loss account is prepared. So in our example, it is prepared for whole full year. So $100 receivables are generated in 365 days. Okay, so how many days will it take to generate $1 worth of receivable? It will take around 3.65 days to generate $1 worth of receivable. 3.65 days to generate $1 worth of receivable. That means I am automatically assuming here that the sales are occurring evenly throughout the year. I am automatically presuming that $1 worth of sales is done after every 3.65 days. Actual circumstances could be different. It could be possible that if the whole year from April to March, if the income statement shows the sale of rupees 100, I am presuming that the sale of $100 is done, $1 is done after every 3.65 days. It is very much possible that whole $100 sale is done in the month of March itself. So this formula altogether ignores this fact. This formula is altogether ignoring this fact. Okay, I hope you are getting into what I am trying to tell you here. So I am assuming that 3.65 days are taken to generate $1 worth of sale. Then if I have $20 worth of payment left with me, then how many days of sale it represent? It represents 3.65 into 20. It represents 73 days worth of sales. So this is our debtor holding period. Debtor holding period, it means it is the receivable holding period. It is the days for which I am not getting my payments from the customer. It was since last 73 days since I got my last payment from the customer. Since these are $20, these are pending to be received as on 31st March, and I am generating every $1 in 3.65 days. So it is almost 73 days since I had received my last payment from the customer. So this is a debtor holding period. But you understand that how much incorrect this is. You understand because I presumed here that the sales are occurring evenly throughout the year. Similar to debtor days, you will also calculate creditor days and stock days. For creditor, you will pick up purchases figure. For stock, you will pick up cost of goods sold figure. Okay. So you will then put that up in that formula and you will get your net operating cycle. So the two disadvantages of operating cycle. What are the two disadvantages? One I have already discussed with you. I am presuming that everything occurs evenly throughout the year, but this could not be the actual scenario in the seasonal business, wherein, for example, if any client is doing a business of winter garments, then most of the sale will happen in winter season only. Okay, so this thing will not hold good where I am presuming that he is selling every $1 after 3.65 days. Okay, so this is the main disadvantage of this operating cycle. Second disadvantage is very casual and normal. I am considering only three factors here: stock, debtors, and creditors. Stock, debtors, and creditors that I have considered for calculation of operating cycle. I am telling that I am telling myself by operating cycle, I am telling myself that for this much time clients working capital funds are blocked. Okay, but this calculation of time is altogether incorrect because there are many other elements in the business which I have ignored. For example, the sales tax or GST in India, goods and service tax is applicable. If you sell goods worth rupees 100 and you have collected rupees 18 sales tax on it, and for the purchases done you have paid 50 rupees sales tax, then the net difference of 32 rupees you have receivable from the government. And sometimes government take around 6 to 7 months to refund back you the money from the GST. So these GST receivables are also your funds are also blocked here. But these blockage calculations are never done in operating cycle. And there are many other calculations that we do in our academics for which are always ignored while calculating operating cycle in banking sector. Okay, so these are the two main disadvantages that I wanted to discuss with you, due to which I always feel that the operating cycle may not be so much reliable for me. So what is the solution? For this point, I don't have much solution for it, that you have to apply your own mind. But for this point, for presuming that sales are occurring evenly throughout the year, I will suggest that I will always suggest that you check the sales trend, sales and purchase trend for last 12 months, month wise. You take the sales and purchase figure month wise from the client and check if there is any trend, any such trend there. If you find any such trend and you think that the due to such trend the assumption does not hold good, then please ignore the assumption of the operating cycle that we did here. Then you simply take the figures of stock, debtors and creditors month wise, for April, May, June, July, month wise, and you calculate the stock, debtors and creditor figure month wise, and you calculate the operating cycle on monthly basis, on each monthly basis, and then you will see the accurate position how much operating cycle is getting moved on monthly basis. Then you will be able to see in which month his actual working capital requirement is there. Okay, so this is the way to follow this, and this is the disadvantages of main operating cycle that you need to keep in mind while making the lending decision. In the next video, that will be the last video on the working capital understanding. In next video, I will be taking one more practical example, although I have taken the example of a fruit vendor in previous videos. But in the next video, I will take one more example. But alongside with it, I will also prepare balance sheet for your understanding, so that you can get things more, you get more clarity out of it. Okay, so I will see you in the next video itself. Thank you for being there.